There's just been some more bad news for the German economy, and their economy seems to be getting worse. They've been doing really badly recently, and there's a lot of talk of them entering recession. The irony of the situation is rich. For so long, Germany has been wagging its finger at other European economies, saying that they're bad and they should run their economies better like Germany did. And now Germany is the one that's catering. But all this time, the only reason the German economy has been doing any better than the French or Italian economies has been because of their exports. Unlike other European countries, Germany's economy has not been running under its own power all this time. It's been leveraging its technological monopolies to extract resources from the rest of the world. Exports are 45% of Germany's economy, so Germany's economic success is completely dependent on other countries. When other economies slow down or otherwise reduce their demand for imports, Germany's economy is going to be hammered, which is exactly what's happening. What's immediately precipitating this is a slowdown in China's economy. However, even if China's economy wasn't slowing down, because it's already more developed and it's moving to a less capital-intensive phase of growth, its demand for German capital goods would be declining anyway. Also, China is moving up the value chain, so it's going to be producing the same goods that Germany exports soon, much more cheaply due to their lower labor cost, and outcompete it. So even if China were growing as fast as ever, its demand for German imports would still be declining. And Germany would still be in the same situation in the long run. So I have this article from Bloomberg that I'm going to read. German industrial recession drags economy deeper into slump. Germany's economy is suffering its worst downturn in almost 7 years, as the manufacturing slump deepens, raising pressure on the government to add fiscal stimulus. Yeah, and Germany's notoriously resistant to the idea of running deficits to stimulate the economy, even though this is the time that they should be doing it, if any. Factory activity shrank at the fastest pace in a decade in September, and growth in services softened, according to a monthly report by IHS Markit. There were also further signs that the labor market is taking a hit. That could have an inverse impact on demand and set off a negative spiral for Europe's bigger economy. The euro fell 0.3%, dropping below $1.10. European stocks declined, with the Stoxx 60 slipping more than 1% as of 10:50 a.m. Frankfurt time. Adding to the gloom, the nation's VDMA Engineering Industry Group said Monday that there's no turnaround in sight. It predicts production will drop 2% in 2020 after a similar decline this year. So they're saying this economic trouble is going to go on for a while. Well, I guess we'll just have to see what actually happens. The confluence of trade tensions, challenges for the auto industry, and looming Brexit are threatening to push Germany into recession after the economy shrank in the second quarter. According to Markit, the economy may struggle to record any expansion at all for the rest of the year. In a sign that the export-driven industrial slump is spreading into the rest of the economy, Markit said jobs growth is stalling after almost 6 years of uninterrupted growth. Manufacturing seems to be in a deep and deepening slump, and there's now some evidence that the service sector is also starting to slow. That broader weakening suggests fourth quarter will be another poor quarter for the economic growth. The latest reports also show weakness in France. That's interesting because for the longest time, in the 2010s, Germany has consistently been doing okay, and France has been the one doing a lot worse. But now Germany's doing a lot worse than France. Though the fact that France is doing slightly better doesn't mean quite as much if it's coming off of a period where France was doing really badly and not growing that much at all. For the euro area as a whole, manufacturing activity shrank for an 8th month, largely due to German weakness, while service growth slowed. The slump in Germany's economy has prompted louder calls for the government to provide fiscal support. While the ECB earlier this month rolled out new stimulus packages for the Eurozone, Germany has so far been reluctant to step up. Yeah, the ECB has basically done everything by this point over the past 10 years of Euro crisis and recession, and they're basically out of anything they could do that actually make a difference at all. So the only thing left is for fiscal stimulus from Germany, Because the other European economies like Italy and France have no more room to run up debt because they're maxed out. So Germany's the only economy that might be able to run some economic stimulus through the fiscal side, and they're really, really resistant to doing it for whatever reasons, cultural reasons, I guess. So that's the big thing that's happening. Chancellor Angela Merkel promised to stick to a policy of zero deficit spending on Friday, even as her administration announced a €54 billion package designed to help put its climate targets back on track. I mean, if there's any time to be running deficits, when your economy's in trouble like this is the time, now. So, they're really resistant to this idea, and it's probably not the best thing for them to be doing, but whatever, that's Germany. The manufacturing numbers are simply awful, market economist Phil Smith said of Germany. All the uncertainty around trade wars, the outlook for the car industry, and Brexit are paralyzing order books, with September seeing the worst performance from the sector since the depths of the financial crisis in 2009. So I have this other article up, and let's see what they have to say. It's from Fortune. Europe has a Germany problem, and it's spreading to global markets. So this is how Germany's bad economic situation is affecting the rest of Europe and the world. As Germany goes, so goes Europe. The engine of the Eurozone economy is sputtering at an even worse rate than feared, new data shows, and it's taking the rest of the bloc, including the Euro, down with it. The closely watched ISS Market Eurozone Composite PMI, released on Monday, shows the EU's manufacturing output fell to an 81-month low. The services sector, too, is failing. New orders for goods and services fell in August, hit by a confluence of factors from the global trade war to Brexit uncertainty to evaporating spending power by Europe's consumer and its firms. It's created a domino effect of bad news. The dearth of factory and service business orders has stymied the jobs markets, so this is basically just saying that, yeah, the economy's getting worse. The weak price pressure is causing GDP to flatline, and now the outlook is growing increasingly gloomy, with renewed fears that the 19-nation bloc is heading to a recession. I mean, if Germany is entering a recession, then there's a high probability to take the rest of Europe with it because it's still central to Europe's economy. But we'll just have to see what happens. The details of the survey suggest the risks are tilted toward the economy contracting in coming months, said Chris Williamson, chief business economist at IHS Markit. Most vividly, new orders for goods and services are already falling at the fastest rate since mid-2013. That was like at the height of the euro crisis, suggesting firms will increasingly look to reduce output unless demand revives. With survey data like this, he continued, pressure will grow on the ECB to add its recent stimulus package. But as I've been saying, the ECB is out of ammunition, and there's nothing left it can do that would actually make a difference. The concern that the European Central Bank will need to intervene further is sending the euro in a tailspin. The US dollar to euro exchange rate is dropping below $1.10 as the markets opened in Europe on Monday, within half a penny of its 52-week low. Earlier this month, the ECB cut its benchmark rate by 10 basis points and resumed its policy of quantitative easing. The plan calls for the ECB to spend as much as $22 billion a month buying bonds from Eurozone countries, for as long as it takes, outgoing ECB President Mario Draghi said, until the purchases begin to goose up inflation rates. Again, the ECB has already done all of this to the max, and doing more of this isn't going to make any more difference. The EU country-by-country economic outlook is down nearly across the board, but the deteriorating German numbers are particularly spooking investors. Germany's services sector in August slowed to its worst rate in the past 3 years, the IHS Markit data showed. Manufacturing in the export-driven economy fared even worse, failing to an 8th straight month and suffering its steepest one-month decline since July 2012. The economy is limping toward the final quarter of the year, and on its current trajectory, might not see any growth before the end of 2019, Phil Smith, principal economist at IHS Markit, said of Germany. The manufacturing numbers are simply awful, he continued. All the uncertainty around trade wars, the outlook for the car industry, and Brexit are paralyzing order books, with September seeing the worst performance from the sector since the depths of the financial crisis in 2009. While the markets had been bracing for more bad news out of Europe, the severity of the PMI data sent Europe indices down across the board, with Germany's DAX down more than 1%. Elsewhere, it's not only set the dollar higher against the euro, but it triggered a run on safe haven US treasuries. So that's what's happening with Germany's economy and why it's getting worse. If you like this video, please subscribe to my channel, hit the notification bell, like the video, and share this video with anyone who might be interested.